Hey, Sats fans, it's Brady Swenson back here with another episode of Swan Signal Live. I believe this is number 84. We've got a couple of great guests today. Alan Farrington, who hasn't been on many Bitcoin shows. So I'm really excited to be able to have the chance to talk with him today. And again, of course, we'll be in Spaces after this for a Q&A. So if you're listening in Spaces now, get those questions ready. Pay close attention. I know you're going to have some follow-ups. All right, class? Before we get, and we have, of course, Anders Larson here as well. And so we will, they wrote some amazing pieces together. But before we dive into the episode, a couple of things from Swan. First of all, Hard Money. It's a new show, a weekly news show about Bitcoin and macroeconomics and exploring the world of Bitcoin literally around the globe. This is hosted by Natalie Brunell, produced by Swan Studios. And it's a high quality, high production value show that is kind of taking the Bitcoin content scene up to the next level. It's really amazing. The second episode should be dropping tomorrow, and you can watch the previous episode on the Bitcoin Magazine channel. We're partnering with them to distribute the show on the Bitcoin Magazine YouTube channel. So go check out Hard Money if you haven't yet. It's really good. And also the Pacific Bitcoin Conference. You can check it out at packbitcoin.com. This is going to be the largest Bitcoin-only conference ever. It's in LA. Santa Monica. We rented out a big airport hangar, and we're going to be putting together an incredible show for you all. It's going to be a lot of fun. We're going to have sports. We're going to have celebrities. We're going to have your favorite Bitcoiners. You're going to be able to interact with them directly in lots of ways. And of course, there'll be parties and other educational sessions and stuff going on all around the conference. So go to packbitcoin.com to get on the wait list, and we'll email you early access to grab some tickets to the conference, November 10th and 11th later this year. All right, let's dive into this episode. Alan, Anders, welcome to Swan Signal Live. Thanks so much for taking the time. How are you guys doing?
I'm doing well, thanks.
Doing great. Thanks for having us.
I just want to say, by the way, before we start, Brady, I find it funny in the introduction you said, I haven't been on many Bitcoin shows, and yet, as I understand it, we're probably not going to talk about Bitcoin.
It's true.
Which is fair, I think, because Anders can be interested in his take on this, but I think I know a lot more about why shitcoins are bad than why Bitcoin is good. So it's kind of vaguely on topic.
Yeah.
I'd agree with that. I don't think Alan actually understands how Bitcoin works. He just understands how all the other shitcoins are bad. So that's my personal take on it.
You'll notice I never offer any technical commentary. I just come out with outrageous metaphors, and people like it.
I mean, it's not quite the same thing knowing how everything else doesn't work as knowing how Bitcoin does work. So I buy that. That's your next, maybe your next book, Alan, is How Bitcoin Works. Alan's journey to understanding how Bitcoin works.
I should do a blog or something, or like a vlog. I should have a vlog of me just like reading Mastering Bitcoin one chapter at a time.
Yeah, there you go. I'd watch it. I would. So let's dive in. You guys wrote some great pieces. One of which you wrote together. Only the Strong Survive, which dropped. What was it, last year? At this point,
September, I think it came out. Is that right? We were working on it for a long time. It's just kind of hard to remember.
Yeah, it's September of last year, I believe.
I think it's got to be the most like methodical takedown of crypto, crypto coins, shit coins, altcoins, whatever you want to call them. And of course, the implication being in the title that all of these projects are fragile. And I'd love to just start with, we'll start with you, Alan. What is the fragile crypto archetype? Like, what are the general qualities that make all of these shitcoin projects weak?
I think there's probably quite a few different qualities. I'll maybe just pick one that kind of stands out the most, and then I'm sure Anders might even have a different favorite to me, I suppose. I'm not sure. The one for me is that they are not decentralized, almost by nature. And we have one of the lines in the piece that I'm the most proud of. I remember chuckling to myself when I thought of it, even before we put it in, is that, you know, the two main issues that we have with decentralized finance is that it's not decentralized and it's not finance. So maybe Anders can talk about how it's not finance. But yeah, I think the key thing that they all seem to have in common is this kind of affinity scam, I guess you could call it. I hesitate a little bit to call absolutely everything that fits this description a scam, which is maybe something that we can come back to, but it is at least kind of technically nonsense, given I think they all fall into one of two camps at a very, very high level. So either they're trying to be money and they're going to lose to Bitcoin, or they're not trying to be money, they're trying to be something else. And there's an irresolvable economic tension in the construction of the blockchain, if you want to call it that way. And what that means is basically that given the native token isn't money, it's trying to be something else. In order for it to survive, which it won't because only the strong survive, the price of the token needs to be both as high as possible and as low as possible. And we can maybe get a bit more stuck into why that's the case, or why I think that's the case. But obviously that can't possibly happen. There is this irresolvable tension there. And ultimately, this maybe segues nicely into, I'm putting Anders on the spot a little bit here, but to talk about why they're also not financed, that they rely on external capitalizations to stay alive at all. They can't bootstrap their own value. Yeah, that's fine. They're not decentralized, and they fundamentally cannot be decentralized.
Yeah, so I'll take a stab at it too, and it might be a bit of a shorter response. I agree with everything Alan said, and then I'll harp on it. The main thing when we were investigating it, really with an open mind, and we mean that honestly, when we were going through, the advent of DeFi, is that what it misses is that what are yields and what are productive assets? Yields cannot exist as a fundamental thing in finance without there being productive capital and productive assets created at the end of it. And so when you look at a large swath of the ecosystem, and I also do not like calling everything a scam. I truly don't, because I think it creates people to be closed-minded. But large swaths, if not almost all of it, is yields that are rehypothecated that don't really come to anything. The only reason the yield would exist is that more capital has to come into the system to produce these yields. And so that's my simpler answer as to that response.
So are these, you make the case in your piece that we can't define these as yields. These are not yields. Yields come from like actual productive assets, and that the term yield is being blatantly misused, intentionally, most likely, to fool investors into thinking that they've got this 15%, 20% yield, which is absurd. So do you, Alan, do you think that, can you talk more about the idea of yield, what it should mean or what it does mean in traditional finance, and what it's being used for in terms of like marketing in crypto, and why are people falling for it?
I mean, I can address that right away, that I have absolutely no idea why people are falling for it.
Straight up greed, probably.
I don't want to psychologize the entire population of people who fall for this stuff. Anders might have an idea, but I do not. I just find it sad. What a yield is, it's really not complicated at all. It's made to seem complicated, certainly in this space, all the time on purpose. So that you don't realize that it doesn't make any sense. It can be made to seem complicated in traditional finance. It's questionable whether the extent to which that's on purpose and is trying to cover something up. But at root, it's just the profit essentially that is generated by a given amount of capital that has gone into an investment project. I'm not sure you even really need to add that much to that description. It can become more specific. If you're talking about debt specifically, it has a slightly more refined meaning, I guess. But even in that case, in any case where it can be used more specifically to refer to, say, a financial product rather than the underlying productive capital that is creating the return that satisfies the demands of the clients of that product, it's still the same thing. It's still capital is being employed productively, profitably. This is the yield at least starts with the return, if it's not then manipulated in some other way after that.
And Alan, if to add to your point on keeping it simple, because I think unfortunately yield is supposed to be a very basic concept in like fundamental economics, but it's been misconstrued. Even in traditional finance, people misconstrue it for their own benefit. Let's use the example I like to use is a farm. You have crops that you're planting. People need to put the capital up front to get the seeds to build the crops. And then in that arrangement, you might not be the farmer, you may be the person providing the seeds. In that arrangement, there is an expectation of how much corn that cornfield is going to yield, how much the farmer gets back, and how much the farmer owes the person who took the risk that the farmer is actually a good farmer and was able to grow the crops. That is what a yield is in everything. And you can take that analogy to basically every financial instrument outside the ones that are even in traditional finance a little sketchy and stuff that in my professional life I don't really touch.
I think just to add to that too, that is not only a good example, it's the perfect, almost the canonical example. And I'd say it's not an analogy at all. It is literally true. And actually it goes the other way in that every usage of the word yield in finance is a metaphor that is based on what Anders just described. So the idea that, which I'm sure we'll go on to, that in this space, and as Anders mentioned in traditional finance too, that it can end up seeming so much more complicated than that, ought to be kind of a warning that something isn't right, because it is exactly that simple, or should be exactly that simple.
So since your piece was published, we've seen a lot of what you explained would or could happen come to fruition. So, you could describe it as some DeFi contagion or crypto contagion. So Alan, did you have any sense of like pride or satisfaction that this happened just 6 months after you published this, this piece saying, here's exactly how this is going to fail, and here are the risks?
Yeah, yes and no. There's a couple of different threads there. I think the one that's important to get out of the way is that obviously we don't take any satisfaction in people suffering
Of course.
needlessly. I think there is maybe some nuance to that, in that if they suffer in a way that isn't truly traumatizing or damaging personally, that maybe is a good thing because it will help them learn. But otherwise, this isn't remotely insightful. Suffering is bad. I don't want people to suffer. I would obviously rather they just didn't do it in the first place, right? That's probably the easiest way of describing this. So that's number one. It is important to get out of the way. Like, we're not gloating about this at all. A lot of it's been pretty tragic. Actually, something that I'm sure we will get onto in more detail, is that the more recent ones seem to have happened in a way that I don't think I certainly didn't predict it. I don't think I had much of a sense of it. And Anders might differ on this, but where the exposure seems to have been predominantly in retail, which makes it even worse in my opinion. Like, I don't, it doesn't keep me up at night that some fund of funds might have blown up, but for, people who are basically lied to on Twitter to lose money, that is a lot more sad.
Yeah.
Another one is some of the stuff that's happened recently is honestly dumber than what we did try to predict. I think some of the things we tried to predict seem to have happened. And actually, the final point I'll make is that Andrew's a better place to answer this anyway, because he's kind of closer to understanding the mechanics of a lot of this. So maybe he did predict some of this. I don't really think I did, because the one that seems to have drawn the most attention since, and which I know obviously you're aware, Brady, I'm sure all the listeners are too, of the Impossible Things paper and the All Fall Down paper, is Luna, which is, and we definitely should get into this because it's hilarious.
Yes,
maybe not right now, but like, honestly, that is so stupid that I'm sure I now know it existed at the time we wrote Only the Strong Survive. I wasn't aware of it at the time, and if someone had described it to me, I would have thought, like, no, that won't get big enough to fail in the first place because it's too dumb. So no, I didn't predict really all that much of it. Maybe Anders did. Anders, what do you think? Do you feel vindicated?
I certainly, again, I don't feel vindicated. Let's get past the fact that we're gloating, or that we like the fact that people have lost money, especially when it's retail, and especially if it wasn't a person who objectively knew what they were doing. But when it comes to the last point, it was actually funny. I'm not going to name any names because I'm a big thing on like if people don't. But someone emailed me who's prominent in the space about 3 months before Luna collapsed, being like, "Look at this thing. Look at Anchor. Look at Luna. Look at this. Look at this whole thing." And I was like, because I'm busy with other things, and I was like, "There's no way this is true." He goes like, "It's someone I really trust." He goes like, "Look into it." And I looked into it. It took me about 45 minutes to be like, "Wait, this is like the definition of like from that scene in The Office in America." I don't know, Alan, if you've watched The Office, the American version, not the original, but like where Michael Scott draws the pyramid, where he draws the pyramid of like, like there's his new scheme. It's just a pyramid scheme, and it was just amazing that people really thought that would work. And again, I'm not trying to be gloaty or like pointing to people, but no, did I think though? It was almost so ridiculous, like Alan said, that it wasn't even addressed in Only the Strong Survive, because I really thought no one would actually go out and do it. And Alan can speak because him and Nick Carter were the ones who published in more depth on that specific one as to why it might be even more ridiculous than what we had anticipated.
Yeah. Actually, Brady, before I don't know if you want to go into Luna right now, but I would suggest we don't, because it's worth not just completely skipping over what we did talk about, some of which I think, at least as far as I'm aware, has started to happen. Andrews mentioned before some of the re-hypothecation that's going on in the space. I didn't really offer much technical commentary at all up until now, but we should definitely talk about leverage.
Yes.
We should have, maybe even without any case studies, like Andrews and I should spend a few minutes describing why it's not intrinsically bad, I guess, but how it has manifested in this space.
Yeah, launch into it, man. I mean, it was on the list, and this is a good time to do it. Yeah.
Well, actually, Andrew, how do you even want to go about it? Do you want to like maybe?
I say you jump on.
Left off with yield.
I think you jump on in first because it's slightly different than yield, right? Because leverage is okay as long as they're real productive yields, and then you can sort of describe out the risk factors, and that's how advanced capital markets work. Leverage in this ecosystem, I'll be brief here, Alan, so I'll let you go on a little bit of a soliloquy and then follow that up. But leverage in this ecosystem, what really concerned Alan and I when we did a really in-depth review, and I did this with other people too, of DeFi, with actually being like, because decentralized finance as an idea is actually a really cool conceptual idea. But like what you were seeing was essentially leverage taken out to take out other leverage to put into yield pools where the yield was not real. The yield only existed if more money comes into the system. So not only, even without leverage, the system is dangerous. But now we've got fake yields that require new money coming in, but that we've also levered up those bets. So the amount of money that needs to come out is actually significantly less than if you hadn't levered it up. It was still a bad idea, but now we've made it like all you need is one blow up, Luna, one blow up, and suddenly you've got Three Arrows Capital going insolvent. I'm sure there's gazillions of other funds going insolvent who played this game not realizing that all you were doing was stacking up a house of cards higher and higher. So I just need to push one card and it slowly started to crumble down. But Alan, that was a little longer than I thought, but yeah, I wanted to I'll let you go off on leverage.
You ended on a beautiful analogy. I feel bad following that now. Yeah, so the link to yield that I had in mind is that I realized that actually the way I described it earlier in terms of the distinction between real yield and what is called yield in DeFi, it didn't quite make complete sense, because more perceptive listeners will have picked up on the fact that the people running these schemes would only be losing money if it was the way I initially suggested. So, because I didn't really offer a complete explanation of this. And what I mean by that is that, so what I said before is, this can only possibly come from external capitalizations. Well, whoever's capitalizing it is in that kind of dummy, obviously stupid model, just giving money to the people who are then, receiving the yield. But they, it's not charity, right? It's a business, I guess. It's a scam in some cases too. Some businesses are scams, some scams are businesses. But the way that the excess flow that is then diverted to the people who think they're getting a yield is achieved is by some or other form of leverage. And if anything, I should probably I don't know if you can see this in the camera, I should do this. It's like leverage. Again, leverage means, so Andrews alluded to this, right? Leverage means something in traditional finance. It's not inherently bad. It's useful. If it's used properly, it's basically, I guess, kind of a high enough level, you could say it's a tool to price risk properly and to establish the most efficient cost of capital for a given project. So that's, you could probably kind of pad that out a bit, but I think that's decent. What was happening here is that the flows that are being redirected to the people who need to buy the assets that will enrich the people running this scheme, that was not being, I mean, I said before, right, it's not coming from anything productive. What it's coming from is taking the initial assets and then basically creating, or like minting, there's a lot of weird jargon that like doesn't quite fit, but minting new assets, using these as quote unquote collateral, and then selling those, and then taking the gains from those sales to pay the yield from the people who bought the first time. And it is basically what Anders was describing from the scene from The Office. It's a tiny bit more involved than a Ponzi scheme. I mean, a traditional Ponzi scheme, you don't really need to get into leverage, but that's kind of how this was achieved here. That nobody was, because I think this is maybe an interesting thing to explore too, that an obvious difference between this kind of thing and just a straight up Ponzi scheme is that with a real Ponzi scheme, you don't have any visibility on what's happening. Because if you did, you'd be like, wait, this is bullshit. Like, this is insolvent right now. Whereas with this, because it's all, it's on the blockchain, right? It's decentralized finance. You do have visibility on it to some extent. And so you can't just move money around, because then people will be like, oh, wait, you just took my money. I don't have any money anymore. Or, valuable assets, I guess it's not really money. So the way they achieve it instead is by essentially, it's kind of this weird mix of, we mentioned rehypothecation before. It's a weird mix of rehypothecation and leverage, where they take whatever initial assets have some value and mint new assets that are allegedly guaranteed by the value of the old ones. But then there's no end to this. It just goes on and on and on. And then it creates that house of cards that Anders described already.
Yeah. And Alan, actually, I think what could be helpful too is that, and it's jumping a little bit past this, but it's also important for us to address the way that we went into our sort of, what would it take, a 6 months straight only the strong survive? And I'd been exposed to DeFi before. It's almost, I'm posing a question to you, Alan, so sorry to put you on the spot there. Is there a way that DeFi and proponents of how it's built today, and certain projects that haven't completely, blown up and they're still sort of chugging along, yes, their token prices are down to whatever, that is there any, like, what is the real value from a proponent of DeFi when it comes to these yields? Like, is there a scenario where these yields actually do enable real world, like you can use these platforms to renovate your home and it's better than going to a bank and getting a loan, right? Like something really real, like, or you can use it to plant a farm and then you can pay it back. Like, I haven't seen many examples of that, which is what always frightened me, but I always want to play devil's advocate to ourselves with regards to that. And I'm not sure if you've come across anything.
Despite not having seen it, I just think philosophically no, because that would be priced in money if it were to happen. And these are very self-consciously not styled as money. So we have the example in the paper, you remember, about how, why, or I forget if we maybe pose it as a rhetorical question, but why would you use casino chips rather than dollars, right? You use casino chips only when you go to the casino, because that's the only time they have any utility to you. And you don't use them in any other circumstance, because you're then also taking on the liabilities of the casino. And both of those doesn't work perfectly, but they have parallels here.
Yeah, that's the thing that I've come to the conclusion to, is that it doesn't really work at the end of the day for true yields and true productive capital without there being a true money that's accepted at the end of it. And I keep wrangling my head as to, because I have a lot of friends who work in these spaces who are really brilliant, but I think they're missing some of those fundamental concepts that we put in Only the Strong Survive, which I'm also just going to put out there again. Alan, I've said this a million times. If someone could please write a rebuff to Only the Strong Survive, not like a blog or like a little tweet as like to why we're dumb and hate mail, or like DM me why we don't understand DeFi or something. Like, trust me, I've been doing this for over 8 years in this space. Like, we get it. I've got a lot of friends who work in this. It'd be really nice to see a retort as to where we could be, like, where can we actually get to a point within these other ecosystems that, and in DeFi as it stands today, that there is a real productive means and asset. It's actually better than what we see today. So I can make a lot of arguments as to why it's worse than what it is today.
Right. I mean, is there any difference right? I mean, the only, as Alan was saying at the top, the only purported difference here is decentralization. Everything else is being borrowed from traditional finance and maybe mashed up into some sort of like Frankenstein, like Luna,
I
to
disagree with that
try
at
to
least.
obfuscate what's going on.
I disagree with that at
Yeah,
least
go
in
ahead.
terms of the aspirations. I don't think any of it actually works, or at least will. If it seems like it's working now, it won't in the long run, because it will all go to zero, and we'll have these kind of deleveraging spirals. But the aspiration at least is noble, which again, this is why I mentioned before, I don't like just universally calling these things scams, because I think a lot of the people involved in it really believe in what they're doing. And so the
Same could be said
entirely
of the
noble
Fed.
aspiration. Sorry?
I just said the same could be said of central bankers, but yeah, go ahead.
Oh yeah, I guess. The entirely noble aspiration is to remove middlemen from the exchange of more than just money, which obviously happens with Bitcoin already, which I think is why a lot of them are not, kind of very self-consciously not trying to compete directly with Bitcoin, because they appreciate what that has achieved. And they want to extend those peer-to-peer benefits to other financial assets. That is a noble goal, and to some extent it is happening. Again, there's this weird nuance here where it is happening now, or it has happened for most of the existence of these things, but their values are predicated on assuming it will happen forever, and or at least in the way that you do, like you wouldn't actually do a DCF exactly with these, but if you assume it's going to end next week, say, then you immediately get into a kind of Keynesian beauty contest about, well, nobody's going to buy it from me because no one will buy it from them because no one will buy it for them. So you do basically have to assume that these are going to exist forever for them to have any value now, and they won't. They'll all almost certainly go to zero. So it's very dubious to what extent it's really working, and I think that's that's what we've seen for a lot of them in even in the past month or so, never mind when we wrote it.
So Anders, you were getting into this idea of using a DeFi, quote unquote DeFi system, to provide like real assistance to accomplish real world projects, right? So a lending platform, for instance, like Celcius, maybe. Let's talk for a minute about these DeFi lending platforms. I'd love to hear what you guys think about them, and in particular Celcius, just in general first, and then in particular Celcius and the situation that Celcians find themselves in now, with withdrawals being halted for a couple of weeks, I think, at this point.
Yeah, I'll go ahead for it. It's I've seen them with a lot of what's going on with like Celcius and a lot of those ones, is that essentially, look, lending inherently, and like when you take a mortgage out and whatnot, there's some questionable practice around that, but it's been around forever, and actually debt is inherently good, and strong capital markets inherently good for societies. What you see with some of these things is that it's not really clear where they were getting their yields from, and that's always extraordinarily scary for me, especially when there are promised yields. So whether you want to categorize Celcius or other people that have blown up, that was what was always fearful for me. Is there a place in the world where you could collateralize an underlying asset and take a loan against it? Yes. By the way, that exists in every modern economy and 90% of the world's GDP. It's called going to a bank, and they have risk managers, and sometimes those risk managers do a bad job. The thing with what's scarier for me with sort of crypto as it sits today is that, again, I could see it moving forward, but essentially what we took is like those risks that we have in the traditional banking system and traditional loans, where we're already seeing it in traditional markets too, where we've clearly over financialized assets and we're going to have to pay the price for a period of time. But in this system, these things aren't even, there's a reason we have securities regulations, just by the way. Like I've worked at hedge funds professionally my whole life. There's a reason we have them, just so I can't just cheat everyone out of their money all the time. And then two is that these are all audited. These are all audited statements, and they show the risk parameters, and whether or not analysts and people in retail do their diligence properly to price the risk versus the return potential. What scares me a little bit about some of these is that it's very opaque where they were getting their yield from. I had felt that way with a company who's I actually admire them to a regard, and I admire their founder, but like BlockFi has had some issues too, I believe, where it was always a little unclear to me where those yields were coming from. which always made me a little uncomfortable to hold if not definitely not a significant amount of any of my assets on there, because I just promised yields without showing exactly where they're coming from is very scary. And you know that right now, no one's actually doing it with these productive assets. I'll let you take it from there because that was a bit of a soliloquy by me. But
I just have one thing to add, which is, again, you brought up the example just of banks, which is, we kind of understand how they work. That demonstrating that there's nothing inherently wrong with, I think, so long as everybody consents and like understands what's happening, there's nothing inherently wrong with borrowing and lending. The issue here is that, again, it's back to this question of what does yield even mean and where it's coming from. There's basically two. I actually realized I missed one in the previous explanation. There's two sources of alleged yield that exactly this kind of borrowing and subsequent lending and creation of leverage is going towards. One is the creation of new assets, which, as we described, or as I described a few minutes ago, I don't think has any philosophical basis. Obviously, other people disagree because there's billions of dollars of market value in this, but my very strong prediction is that, again, that will all go to zero. And the other one is facilitating trading. So it's probably not worth going into the kind of the technicalities of this, I guess, but either offering up the assets to be shorted or levering up attempts at arbitraging against different markets, this is particularly insidious because even that, I would argue, certainly in TradFi, there's nothing intrinsically wrong with that. You could even make the case that it's facilitating price discovery and it's helping capital markets be as efficient as possible. But that only makes sense in TradFi if there is an underlying yield on which these assets are being priced. Here, there's not. So again, you get back to this question. Anders is equally as confused by this in his previous answer, I think. Where is the yield? There is no real yield that satisfies the interest that needs to be paid to grease the lending and borrowing markets at all. It's all fake. And now we're seeing what happens when that gets exposed.
So since we're talking about these kind of these traditional finance services being transferred over into this DeFi system, I'm wondering if there's any ways that you guys can identify and expound on that Bitcoin will fundamentally change traditional finance, assuming we have a truly decentralized finance system built on top of Bitcoin.
Yeah, I think it's back to the noble aspiration, which is to remove middlemen and allow not just money, but financial assets, let's say, anything that you can have a title to be able to trade that peer-to-peer. I think that's pretty straightforward. It's being explored in DeFi, and I think it's maybe something that's even worth giving credit to, is that it's significantly further ahead in terms of actually exploring the design space than Bitcoin is. But again, it's just back to this problem of will there be any long-term value creation from this? I strongly doubt it.
Anders, how about credit? Will the credit system as it exists today in traditional finance be fundamentally different on a hard money system as opposed to a debt-based money?
That's an interesting question, actually. Wow, I haven't thought too deeply on the credit side of that based on how it's denominated. I don't think I actually have a really good answer for you on that one. It's a very good question. If I may say one thing to Alan's point, is that I think it goes to something that is important to reiterate. Both of us love the concept of decentralized finance. I mean, it's an absolutely beautiful concept. It's just when you actually went through the layers, you look at the big platforms and like how the yields are being made, that was what was really scary to us. But I'm sorry I wasn't able to answer your question on credit because I actually need to think about it for a second. That was not something that I'd really had an articulate answer to. Maybe Alan does. Maybe he's already computed it in his head. But how it would look different fundamentally. I mean, credit scores, all that stuff, that shouldn't look that fundamentally different actually, because you would it's the same sort of like algorithms you'd use to determine someone's credit score. but like credit as a thing in and of itself in financial markets, wow, you kind of got me there. I don't actually have a good answer for that one. That one's going to be an interesting one for me to puzzle. I don't know, Alan, if you have a good answer on that one.
Yeah, I mean, I don't think I have a good or a great answer on this. I'm almost a bit wary because if anything, I think an answer is it will look very, very different. It'll probably look different in a number of ways that haven't occurred to me, possibly that hasn't occurred to anybody yet.
Yeah.
So I by no means implying that what I'm about to say is like the entirety of, okay, this is how credit is going to change and we know that and it's fine. We'll just prepare for it. I think the main one is that it's just going to be significantly less attractive and will happen a lot less because I don't think anything about demand for debt will change, but an enormous amount about supply of debt will change. Because if you don't have deposit insurance, for one, if your opportunity cost is essentially kind of aggregated return on capital in the economy in the form of deflation, such that you don't need to chase yield in the first place, and finally, with those as the background, the question then just becomes: are you willing to take 100% downside risk for capped upside risk?
Mm-hmm.
Probably in some circumstances, but in significantly fewer circumstances than today. I quite strongly believe. I'm being deliberately a little bit vague there because, again, I don't want to imply I have actually worked out how this is going to happen. But I think the motivations or the difference in motivations are probably quite clear. Like that seems straightforward to me that people would have that attitude, and hence far more, not all, I don't think, but far more finance is likely to be not necessarily literally equity investments, but equity based, where there's far more sharing of the upside and the downside rather than a fixed return.
Yeah.
Alan's response gave me a quick brain sparkle on this, actually. One analogy, so it doesn't totally solve your question, because I'm not sure, because it's hard to see it because there hasn't been many historic examples. But actually, one very good example is looking how money supply and how the Federal Reserve raises and lowers interest rates in the money supply affects the attitudes by quote unquote professional investors and retail investors and everyone else. Right now, for since the financial crisis, essentially, given that we kept getting bailed out by the Fed anytime anything happened, people were chasing drastically higher returns, and they were drastically overvaluing software companies. They were giving people 50 times revenue multiples. It's obviously all compressed from here, but that's because they almost had to, because they had to chase yield. In a world where money is sound, or at least the Fed does their job maybe more appropriately, and money's tight, let's not call it appropriate, inappropriate, but when money's tighter, you'll notice the bar for yields is actually significantly lower. Suddenly 6% a year sounds really darn good. I mean, this is why Warren Buffett's been amazing at his job, because he's understood that fundamental thing. So anyways, yeah, I'll stop there.
I look forward to the co-authored paper on this question. I'm sure there's a lot of good historical analogs as well, and periods of tight money or hard money that we could look at as well. So let's take a look at this. Do you guys think that Bitcoin is strong enough to survive? And let's just go down the path of Bitcoin somehow fails. Do you think that we'd have another chance at building a truly decentralized money and finance if Bitcoin does fail? Let's go with Alan first in this one.
This is hard. I feel the need to give an even stronger caution that I've absolutely no idea, so don't take this as gospel. I think probably if Bitcoin, I don't even know exactly what it means for Bitcoin to fail. I mean, does it, people will always run nodes. I mean, I guess it just means something like, it's so heavily criminalized that you can never rely on using it. And then, there aren't even markets for it anymore. So there's not a price, something like that. So, okay, we'll assume that's the failure state. I think that's it. I think it's over if that happens, because why would anybody ever try again, given all the effort, or at least in the same way? I mean, maybe somebody comes up with, maybe whatever the reason it failed is then gets solved in some new thing. I don't know. But certainly no blockchain-based system will ever succeed if Bitcoin first fails. How likely is it? I mean, I honestly have no idea. I think one of the more rather than like putting a number on that, I'm not sure that would even be meaningful if you did have a solid idea of it. I think it's more interesting to talk about why it might fail. Like, what are the most obvious reasons that it could fail? Partly because it's a more coherent discussion you end up having, but I think also because it's practically useful, because then you can think about how to guard against that happening. And there's one that I really like. I think there's some pretty obvious ones. There's like the Joe Kelly one, which we can maybe get into if you want. I'm not sure I can say that all that well off the top of my head. I might need to just pull up his article on it. But there's one which I attribute to a guy called Ben Hunt, who's super interesting. He's Epsilon Theory on Twitter, which is named after the really popular financial blog, which is just called Epsilon Theory. That he I think other people also contribute to it, but he's kind of the editor in chief kind of thing of it. And so he said this he might have said it elsewhere. He might have written about it on Epsilon Theory, but I remember him saying it to me and Alex Svetsky on a Clubhouse about maybe 2 years ago, or no, 1 year ago now, about a year ago. So other people may also have made this argument, but I attribute it to him. That was the first I heard it, where you have this threat that's kind of akin to Web 2, basically, like what ended up happening with Web 2. And in particular, I think email is a really good example of this, where you can run your own email server if you want. Nobody can stop you. But basically nobody does, because it's just kind of a pain. And so almost everybody uses pretty much like Google or Microsoft. Some people still use Yahoo, I guess. And then you've got these like tiny fringe cases of like pop-up ones like Proton Mail or whatever, which are deliberately positioning themselves as the anti-Google in this regard. But even that like doesn't quite capture it, because real anti-Google is just doing it yourself. And so obviously the default state, not only the default state, but the obviously beneficial state of Bitcoin is more like running your own email server, not your keys, not your coins and all that. But what Ben Hunt articulated is that there may well be a similar social reaction as there was in Web 2, where actually, it seems like it's going really well to start with, because it's only the people who are super into it, probably for ideological reasons, or at least partly ideological reasons. And hence they are far more receptive to, running their own server, running their own node. But as it becomes more and more normalized, you find that what becomes a majority, and then the vast majority of people who use it, use a Web 2-esque version, which I think in this case would be something like, or I think the way it would come about in this case would be, whitelisted Bitcoin only. And then, so even that presents kind of an interesting discussion about, well, okay, is a whitelisted Bitcoin just a shitcoin, and like, does it even matter? Maybe it does if it drives the real Bitcoin usage so underground that it's just like irrelevant, because nobody even knows what it is. And actually the particular point that Ben Hunt made that I really liked is that this is more a social attack than anything else, because the way this, like the really horrible way this could manifest, is that the vast majority of people don't even know, right? So you can't relaunch your not your keys, not your coins, because, as like a meme, because nobody even knows what that means. They're like, you try to pay with real Bitcoin, and you're like, no, that's a shitcoin. And everyone's like, wait, what? I know I have Bitcoin. This is Bitcoin. This is what Bitcoin is. This is how it works. Like, why are you using this other weird thing? So yeah, I think that's a fun one to kind of, well, I mean, it's not fun, it's terrifying, but it's an interesting one to ponder. I don't know if Anders has a favorite attack, a favorite way Bitcoin dies.
Yeah, no, I mean, I actually is much shorter. I think just your original question, is there a chance Bitcoin fails? Absolutely. I find it ridiculous that someone says there's a 100% chance of anything in the world. So yes, there's absolutely. I think that if it fails, given that it started with the idea of being money, which I think is the premise to then create economies around it, is why it has the highest chance of success in the long run and actually providing value to people, because it started from that first principles of like what the innovation was. Because, Amazon works fine. Maybe there's problems, but like Visa works fine. Yeah, they overcharge. But, we have to solve what I would say is almost the answer to that question is yes, absolutely. It could be highly criminalized. People just don't really accept it. It's sort of a fad. 20 years from now, people forget about it. And that would be failure in my regard. I also would be failure for me for Bitcoin not to succeed, frankly. And might be a bit of a, some maybe heavy Bitcoiners might disagree with me on this one, is that if in 10 years or so, let's give it a wide time frame for technology advance, people aren't using the Bitcoin settlement layer for transactions on Lightning or Liquid or anything like that, that actually is providing value. It's cutting out middlemen. It's allowing payments to go fast. It's allowing people to have completely private interactions, et cetera, without them even knowing that they're using Bitcoin. Then Bitcoin, in my view, would have failed from what my hopes and expectations on a 10-year basis is. It's similar to the internet. Almost no one on this call and 99.99% of internet users actually understand how the internet works. Like, go step by step on how the internet works. Yet we all use it every day. And so I think that's sort of an answer to your question. Sort of the best answer I always give to people is that is why Bitcoin should remain valuable and it has to be valuable in the long run for it to succeed, in my book.
Yeah, I think those are both in my top 5 for sure. And I think another one I'd like to ask you both about, given your careers and experience, is the over financialization of Bitcoin. And we're talking a lot about DeFi here, and the decentralized part is really important. But we also have a lot of centralized financial instruments that affect Bitcoin in some way or another. A Bitcoin short ETF was just approved, for instance, and that could be used to suppress Bitcoin price. We've talked a lot as a community about how gold price was suppressed like systematically with certain financial instruments, and how Bitcoin could avoid that because of easy self-custody. But of course, that requires people to self-custody. So what level of threat do you think these traditional financial instruments applied to Bitcoin pose to the success of the project? And Anders, I can toss that one to you, or you can throw it back at Alan, whichever.
Let me throw it back to Alan, because actually in one of the pieces that we have linked about Loon, I think he put some beautiful quotes in there about this, about why those things are, yes, affect price in the short term, but it's exogenous to what Bitcoin is as a project in of itself. So I'll let Alan, because I think he actually has some beautiful lines in recent pieces he's written with regards to
that. Yeah. To be honest, I don't really worry about this all that much. I think for 2 reasons. One is that if you have a long enough time horizon, this stuff just washes out, right? If you care intimately about the price of Bitcoin on a month-to-month, quarter-to-quarter, year-to-year basis, then yeah, this can be really terrifying for you. But then I think that leads into point number 2, which is why would you, unless you were levered? Which is kind of what we're kind of dancing around here, right? That we're now seeing there's enormous selling pressure on Bitcoin from people who had it as an asset, which depending on maybe it was literally or at least was styled as being collateral for something, or maybe it's just the way that their business worked, that they also had liabilities that are now collapsing, and so they need to liquidate their position. But the reason I also don't worry about that is, well, it's not so much I don't worry about it. I think obviously we're seeing now it can be really dangerous, but it's also, I think it's kind of pointless to worry too much about it happening precisely because it's so open, right? It's permissionless. You can't tell, well, you can tell people not to do it, but you can't make anybody or stop anybody from doing this. I think the short ETF is a great example of this, that absolutely should exist. I mean, it's obviously going to exist at some point anyway, but I'd even argue it should exist, because if Bitcoin can't withstand something so obvious existing, then like, what's the point? It's clearly not strong enough to survive, I guess. That's a good note to end on. Throw it back to Anders.
Yeah, no, I don't have too much to add there, because it's unfortunate that, over financialization, short ETFs, I mean, that exists. It's markets. You should be able to buy and short things, actually. It's funny that they have a short ETF and not a spot ETF, right? Which a little ridiculous when you think about how financial markets should operate, but I don't see it as a fundamental threat to Bitcoin. I mean, yeah, Bitcoin price drops, maybe hash power has to go down. So people would say the network is, less secure than it was. I mean, it's still an immense amount of hash power on there, an immense amount of computing and capital. But yeah, I would say that yeah, I guess simply no, I'm not too worried because it won't really end up affecting like Bitcoin as its network. So it really stays at that for me.
All right. So what do you think? Hold on, let me hold on one sec, Sam. There we go. What do you think about regulation? Do you agree that most of these projects are unregulated securities or illegal securities because they come from a centralized issuer that can be identified? And do you believe that there are any other digital assets out there that could be qualified as a commodity in the sense there's no centralized issuer?
So it's hard to kind of clarify all of it because there might be like you can maybe argue Ethereum's also a commodity too, but there were centralized issuers that had it was very clear. This is not what I'm about to say is not saying that I agree with everything the SEC does and everything that regulators in the United States do. But if you just look at the text of the law, and if you've been in this ecosystem enough and you know the insiders, you know the VCs, I mean, they're very obviously most of these things are securities. There are centralized parties of people for even most DeFi projects. Like, I joke from where I live, which is a huge DeFi hub. Like, you could, if you bombed like 5 square blocks, like half of the DeFi world would be like destroyed. It doesn't sound very DeFi. It's like they're just right there. So it would be hard pressed in a court of law, I think, for a lot of these teams to not like face the test of how the SEC today clarifies securities and securities laws. And so there is a reasoning for securities laws too. I've spoken with some lawyers who are big Bitcoiners, actually into a lot of other crypto too, who are like, we don't need to relive the past and make all the mistakes that we created. And there's a reason securities laws exist. I'm not saying all of them are correct. I'm not saying some of them are fine, but from the United States perspective, I mean, some of it could not be more blatantly obvious. I mean, the rampant insider trading, the rampant, like all these things that are going on screams security and or actually probably better penny stock. But yeah.
Mm-hmm.
There's an important point to add to this, and we very deliberately said almost exactly what I'm about to say in Only Strong Survive, which is that our view is not that they should be shut down by the SEC. It's also not that they shouldn't be. I mean, my take at least is I don't really care whether they're shut down or not. What's important is that they can be. So if they are clearly securities, and actually while Anders was talking, I pulled up the Howey test, which is what the SEC uses per the Supreme Court to determine whether something is a security or not. It has 4 components: an investment of money, yes, clearly; in a common enterprise, yes, clearly; with the expectation of profit, maybe, depends if you believe the yields or not. 4, it could be derived from the efforts of others. Yes, clearly. So these clearly are securities legally, almost all of them. And again, it's back to the distinction of are they trying to be money or not? Almost none of them are trying to be money because they don't want to compete with Bitcoin. So they are, sadly, by definition, securities, even if the people running them and engage with them and so on don't actually realize that. So the SEC clearly has grounds to go after them. And what matters is that they are not decentralized. Again, to go back to something we started with right at the beginning, if the SEC, if basically, you don't even need to say the SEC, if men with guns, right, decide that they want to shut this down, and which they may well do because clearly they have a good reason to, as I just described, they can. And then it's over. Like that's just it. And then so that's back into or at least it's partly back into the kind of pseudo Keynesian beauty contest that I was talking about, where it might seem like these things are working. You can look on chain and be like, oh yeah, that worked. That person paid that person, and the thing is still alive or whatever. But it's highly questionable why any of it should have value, which is also key to how it allegedly works. And clearly it's key to why people should buy it. If this could happen at any point, and probably will. So it's not that I want it to happen. It's that it will happen.
Right.
It doesn't matter what I want or not. I don't run the SEC.
So I assume in your opinions, there is no other digital asset that could be deemed a commodity or otherwise not a security. I think Ethereum might have some, I don't know, there's some issued like opinion from, and I don't know, this is many years ago and I haven't like followed up on it since then. I'd be interested to check it out. But that Ethereum might be defined as a commodity by some organization, the U.S. government.
That. I'm by no means a legal expert at all, never mind on this. But what I remember was that it had basically been grandfathered out of consideration of this kind of thing.
Right.
Which since has been picked up by a lot of Bitcoiners is like, well, that's bullshit. It's clearly, fits the Howey test. Yeah. But I think practically it seems, as far as I'm aware, it seems unlikely that will ever happen for Ethereum specifically.
Yeah.
Other than Ethereum, and this is not legal advice. So no one, please, what's a disclaimer you have to always say? It's not financial advice. This is not legal advice. But yeah, there was sort of like it happened so long ago, and since then it's sort of for Ethereum. So Ethereum maybe, and then the other ones that are actually worth mentioning would be like USDC as like a stable coin, that is regulated and audited by governments that have sanctioned them, especially the United States. If it's a US dollar-backed stable coin, that the bank accounts are regulated and audited, that's not security. That would be a commodity or some sort of a weird, again, not legal advice. That wouldn't be a security. Which, by the way, we just mentioned like 70% of crypto's market cap is like Bitcoin and stable coins, and then like I throw ETH in there, and that's like 80%, right? So that's like most of the money in this space.
Yeah. And I find it just ironic that Ethereum is the mother of most of the shit coins, at least the early ones, until there's Ethereum alternatives that have come around and tried to build some and take some of that steam. But hopefully that gets changed. Quick question to wrap up this part of the show before we head over to Spaces for some Q&A. So if you're listening in Spaces or you're watching here on YouTube, head over to Spaces, think about some questions for these guys. It's a good opportunity to find out what they think about whatever you are wondering about. So last question is, have either of you been following DeFi on Bitcoin, like the developments there? So like, I think it's being called LiFi, Lightning Finance. So this is still a pretty nascent, area of Bitcoin development, but wondering if you have any projects that you're watching, have an eye on, or are curious about.
I can jump in just because I know I have a different answer to Anders. The one thing I'd say, I really don't like the expression life. I know it was in a paper that I wrote, but I don't know. I maybe could have fought more to not say that. I just think it's kind of cringy. I'm sure Anders will probably have a lot to say about. I don't want to put him too much on the spot, but I would imagine Taro. I would imagine stable coins on Taro, but maybe other things he's interested in too. The one that I like highlighting though, just because of my connection to Blockstream is Liquid. And in particular, just again, this is sort of fairly straightforward concept that has been toyed with in non-Bitcoin DeFi, but having tokenized securities. And so I think this is maybe more philosophically interesting than practically, in part because there's kind of a cell phone here in that there isn't really that much of it happening yet. This is something that Udi Wertheimer likes to occasionally tease Adam back about, that there's like basically nothing happening on Liquid. But it's interesting why this is the case. And I think Udi knows this, but his trolling is still pretty funny, which is that, it leans into the philosophical issue in that I'm very wary of being too kind of, I don't know, excited or animated or whatever about the concept of decentralized finance too much in the abstract and with too much kind of hopium almost around what, we're just going to like decentralize everything, right? It's like, there's that meme from, I think it was kind of in reaction to the chaos of 2017 of like, put everything in the blockchain. Like that's really not what I'm trying to describe. The key philosophical issue, I think, is that with in particular a security, but certainly with anything other than Bitcoin, and this is kind of getting into almost section 1 of Only the Strong Survive, like why these other things probably won't work in the long run. You need it to be money for the incentives to be in place. So for anything that isn't money, you have to, if you're trying to talk about this even remotely seriously, you have to acknowledge that there is an issuer, right? Securities have issuers. Bitcoin doesn't have an issuer. Everything else, that including Taro stablecoins, which hopefully we'll get onto, everything has an issuer, and so in that sense is necessarily centralized. And it's just nonsense to talk about it as if it were any other way. It's like a category error or something to talk about a decentralized equity is meaningless. It's literally meaningless. That doesn't mean that you can't bring many potentially features of what we've been talking about as kind of the noble aspirations of DeFi to securities, and hopefully to securities built on a or DeFi securities built on a Bitcoin base in the first place. So you can to me, I think the fairly obvious goal with tokenized securities on Liquid is to strip out custody and settlement from absolutely everywhere that they exist, or as many places as possible that they exist in global capital markets, because they're just like not necessary anymore. And it's not even here, I hesitate a little bit, because I'm not saying like, oh, these are parasites, like how dare they ever have existed. Like, they used to need to exist, right? You couldn't have capital markets without basically say as suggestively as possible, keeping the ledgers up to date. But now you can. And so that's quite exciting, partly just from a cost point of view, although that's pretty boring in the scheme of things. But from what it enables in terms of peer-to-peer trading and actually adding programmability into the securities as well. And kind of, I think that in particular is nice because it opens up, or it makes it open. Let's say it turns it into kind of a platform where, again, we're back into like, I have no idea what people are going to do with this, but it's exciting because there's a lot more capability there than has ever previously been the case. So that I'll leave it at that one. It's tokenized securities on Liquid is pretty cool. Anders, you want to talk about Lightning?
Yeah, I mean, I think with Lightning, of course, so Alan actually mentioned two of the ones I'm obviously going to say about stable coins. I think will be awesome with Taro. I'm not going to go too in depth right now because I don't actually think it's just like an idea. I think people understand of why that could be useful, like instant transfers and whatnot. The securities are also interesting. And then there's also some sort of lending that can happen on Lightning that's actually for parts of those loans is actually much more secure than you would almost ever see, because you actually don't lose, in certain parts of the loan, you wouldn't actually lose custody of your Bitcoin principal, even if your other party defaulted. You just simply wouldn't get all the interest that you had expected from sort of having lent out their Bitcoin. But that's getting a bit technical. The main part when I think of DeFi on Bitcoin, which is very nascent, and it's also why there's been criticisms from Alan and I on DeFi as it stands today and other ecosystems, is that one thing people also need to answer with tech innovation or innovations in money is that what are you actually solving for? Like, what are you actually helping people do better than they did yesterday? And Alan gave a really beautiful example with securities where, it's not that these guys, these custodians that have existed, like, are doing anything bad. That is necessary in the current system. But in new systems, like what he described with Blockstream, you can maybe cut them out. And that's a big, I don't know what their market cap is, but it's a very large industry. And so you're actually saving middlemen fees. Unless people who are building even DeFi on Bitcoin can point to why this is adding value to their end user and why this is better than what already exists, especially for the vast majority of, like, you could probably point to some very underdeveloped countries, but that's not where the vast majority of wealth is and GDP and everything, is that you need to be able to answer that question. And so that's been my exploration of Bitcoin DeFi, or I guess LiFi on Lightning, is that let's make sure when we look at projects, it's like, okay, specifically, why is this better than what we currently have? And I think Bitcoin did a beautiful job with that with regards to money. But now if we're going to do DeFi on Bitcoin, we need to have objective reasons to that too. So I'll stop there with my response to that.
Awesome, gents. This was a great conversation. We're going to head over to Spaces and hopefully get some questions from watchers and listeners. So I'll let you guys go over there while I take us out. I want to give you guys a quick look at Hard Money. So I'm going to play a quick video here on the way out, and then we'll meet you all over at Spaces. Again, Hard Money is our new weekly news show hosted by Natalie, Brunell, produced by Swan Studios, distributed by Bitcoin Magazine. We're all very excited about it. So check out Hard Money on the Bitcoin Magazine YouTube channel, also on Spotify. And we'll take a look at it now.
Hello and welcome to Hard Money. I'm Natalie Brunell. Bitcoin remains in the high... Hope House here in El Zante. It is a community center that does outreach at Bitcoin Beach. Look, they even got their own Bitcoin mobile.
I want to start a Bitcoin caucus with other elected officials across the political spectrum.
It turns everything brighter. Magic money, baby.
Goldman Sachs has offered its first Bitcoin-backed loan for cash.
Everybody knows the word Bitcoin.
The Bitcoin. Oh, Bitcoin. Bitcoin.
Bitcoin.
Sí. Economic freedom with Bitcoin.
On Hard Money, we'll bring you the top headlines of the week with analysis you won't find anywhere else. I'm Natalie Brunell. Welcome to Hard Money.